Hey everyone, this is Brian Bogner with Parallel Financial, and just wanted to follow up with you from our survey a couple weeks back and answer some of the questions and concerns that you had about the market. So let's go ahead and dive right into this. Just bear with me one second here. There we go. We're going to go ahead and start here with a chart of the S&P 500. That's what the orange line is that you see. The blue line is a chart of the assets that are on the Fed's balance sheet. So as the Fed has been printing money and buying assets, they've been increasing their balance sheet. Well, you can look at this chart. Again, it doesn't take a rocket scientist to figure this out, that as the Fed has been increasing their balance sheet, the stock market has been moving higher. And here at Parallel, it's been our belief here for the past few years that, in fact, the U.S. stock market has been a function of Fed policy. And really, it's this liquidity and the increasing of their balance sheet that's what's been pushing the market higher. As you can see, since late last year, they stopped buying the assets, the quantitative easing. They stopped that program, and so as their balance sheet is flattened out, really the market has pretty much flattened out during that time as well. So we're on a very kind of a look and see environment right now here to see how is the market going to react now that the Fed is no longer increasing their balance sheet. It's not to say that we think, oh my goodness, the market's going to crash, it's going to, we're going to see it drop or go down or anything like that. It's just that, okay, over the last 5-6 years, we've had this relationship here that has been pretty spot on. So what's going to happen here? Is it going to continue? Is it going to separate? We're still a little too early in the game yet, and we don't know. So it's just something that we're really watching very intently right now. There we go. We are entering into probably two of the worst months of the year when we consider the average performance of the S&P 500. This is going back to 1942. As you can see, August is pretty much flat historically, and then September is actually the worst month of the year. So we're entering a phase right now in the markets that historically has not been too positive. Again, we're not saying that we're going to have a bear market or a big crash or anything like that, but we do have some concern that these next 2 months tend to be some volatile, choppy months. One thing we've been doing as a firm is just raising a little bit of cash here just to stay somewhat on the defensive. This is a chart of the U.S. dollar because in our opinion right now, the U.S. dollar is kind of ruling the world. If you look here, since last July, big move up here in the U.S. dollar compared to all the other currencies around the world. We've had a little bit of a kind of a sideways pause here since the beginning of this year. But if the dollar continues to rise, it's something that look, if you're a company here in the United States and you make widgets and you're exporting them around the world, well, guess what? A strong dollar is not helping you. Fortunately, for like if you're in Europe, for example, and you make widgets and export them, and the euro has been declining, especially against the dollar, you're loving this because now more people can buy more and more of your products. So this is really having an effect right now on global trade, on big multinational companies, and in many ways has been kind of indicative of where we're seeing capital move in different parts of the world. So right now the dollar, big move since last year, kind of taking a bit of a breather here, and we're a little bit of wait and see what the next step is. Now that being said, next two charts you'll find pretty interesting. Got a lot of questions on the survey about Greece and Europe and how does it affect and things like that. Well, this is a chart of Europe. So if you own the Europe stock market, kind of all of them together in U.S. dollars, this is what your equity graph would look like, which is pretty much you had a big move up into 14, big sell off right into January, kind of move up, and then really this last line here was the Greek issue most recently, and we've actually recovered from a good portion of that already, but kind of flat when you think about what's happened here over the last year. However, if you own Europe denominated in euros, not in the US dollar, well, guess what? You've actually are in the positive, slight move higher. So when you really think about this big move up here in the US dollar is also this big move down in European stocks denominated in dollars. But again, during that same time frame, really Europe was pretty flat in terms of their stock market. So when we think about Europe right now, we're actually seeing some value there, and that's what this next table here shows us. These are price to earnings ratios with basically every major country around the world, and I have them ranked from lowest to highest. So this cyclically adjusted price to earnings ratio here, you can kind of see what the cheapest markets are in the world all the way down to the most expensive. Well, guess what? The United States is one of the most expensive markets in the world right now. What are some of the cheapest? Well, Russia's the cheapest, but there's obviously some geopolitical concerns there as well. But when we take a look down here, we've got Brazil, Portugal, Poland, Austria, Spain, United Kingdom, a lot of European countries, heck, even Greece is in here as well. If we just take all of developed Europe, we're trading at about a 15 PE compared to about a 25 PE here in the United States. So in our opinion, a lot of this recent volatility here is potentially providing an opportunity here in some of these overseas markets, especially from a valuation perspective. Last thing that I'm going to talk about here is interest rates, because there's been a lot of asking about the Fed and things like that. Well, the Fed just controls what we call the short end of the yield curve, meaning the overnight Fed funds rate. There's a good chance they're going to raise rates sometime here in the near future. But with a rate at 0, and if they go up 25 basis points or maybe even 50 basis points, is it really going to be that significant initially? Because whether you're paying 0 or 25 basis points, are we really talking about a huge move? Where we've seen the big move, however, is on the longer side of the yield curve, meaning a 10-year, in this case, this is a chart of a 10-year treasury. So if you look at the past year and a half, big drop down in yields from 3% all the way down to 1.65% here over the last kind of year and a half. Well, since then, big move up in interest rates from 1.65, we're right about 2.3% right now in the 10-year yield. And so that has us watching here, okay, are yields starting to make a move higher here on the longer end of the yield curve? Well, at this point, it looks like they are. And as a result, if you look year to date, things that are interest rate sensitive like utilities and REITs and MLPs and just things like that have been very negatively impacted. The last thing here on the interest rate side, very similar to this, is what we do is we take this orange line here is basically kind of a index covering all the corporate bonds in the US. So that's high yield and investment grade. And then we compare it to the yield on a 10-year treasury, okay? And then this line down here plots the difference between the two. If the line is decreasing, we say that spread is narrowing. If the line is increasing, the spread is widening, okay? And what that means is when this spread is narrowing, it means that more and more people are buying riskier assets and willing to take a little bit of risk and bidding up those prices, thus bringing those yields down. When we see these spreads rising, people are saying, uh-oh, and they start moving money out of riskier assets into safer assets, and then we see those spreads expand. And what's happening right now, really, since the middle of last year, matter of fact, if you look here, this is July of last year where we saw that rise in the dollar. Well, sure enough, we've also seen spreads move up quite significantly since then. Little reprieve here into the beginning part of this year. Now spreads are starting to lift off again. If this continues, it's also going to give us more pause, especially when it comes to U.S. stocks, that money are flowing into less risky assets right now. So in summary, U.S. stock market is the most expensive in the world. It is showing some weakness here. Foreign markets are cheap. However, they are volatile, as we've seen with Greece, as we've seen with China. But on a valuation, they're much less expensive than the United States. Greek and China are big news events, but really haven't changed anything significantly. So it's not like any of the news recent on Greece and China has been like a game changer, and now all of a sudden things have changed. What have been the game changers? U.S. dollar, rising U.S. dollar, Fed policy, interest rate move. Those are I would say, the three things that we really are looking at. So we just want to caution you to say, yeah, we know the headlines are out there, but the real three things that we are looking at are, what are interest rates going to do? Is Fed policy going to continue to influence the stock market like it has been? And how's the U.S. dollar going to resolve here or continue to move higher? So again, if you have any questions, please email, call, contact us, and thanks so much for listening.